What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies, and please make sure you change Facebook to ticker symbol META for Meta platforms. And as always, we've got 2 additional trade ideas to share with you towards the end of today's video, so certainly stay tuned for that. Anything we are associated with is linked down below in the description, and without further ado, let's jump right into these charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a full-bodied red candle, virtually no upper wick to read into, no significant buying pressure there, and perhaps the most important part is the close of the weekly session, dead on the lows of the range here. Now, we do know that a significant portion of this range is comprised of a daily gap. We'll see that in just a moment, but for all intents and purposes from the weekly time frame, we do have to give structure to the bears on today's session. From a location standpoint, of course, looking at a bar-by-bar perspective, we have a slight lower high, but perhaps, again, the most important part is the close of this week, which did produce a significant lower low. The reason why this is so significant, not only from the perspective of taking out the prior week's low, is the fact that we formed equal lows to what we had earlier on in the beginning portion of May. So what that's done from a trend perspective is really make it kind of impossible at this point in time, to be quite frank with you, to put in some sort of higher low reversal, right? If we were going to do something like this, obviously that would have required a significant higher low above this set from right around in here. So now, to reverse the trend, we have to once again rally and then put in a higher low, or we have to now take out this set of highs. This, to form a higher high, would have had to come all the way into here, but now that we have this as a lower high, right? So from here to here to here, now any reversal needs to take this out before we start getting bullish or put in that higher low as we've just described. So overall, before we get too far into pattern and Fibonacci's, which we'll do on the weekly time frame in just a second, structurally and location-wise, everything's kind of falling into the bear category at this point in time here on the weekly time frame. We should also just tie this in directly to pattern. If we remember that we've been monitoring this head and shoulders, correct? Our neckline was right around in here. We were saying in the prior videos that, sure, we're accepting at the neckline, but it's not really enough to negate the head and shoulders pattern until we get a significant move away. Obviously, we can see clearly now that this has just been a break and retest. And if I draw it in like that, you might also recognize this portion that I've just drawn as an H pattern or just a bear flag, right? Overall, here's sort of the H perspective, or you could do something like this and say bear flag here on the weekly time frame as the next pattern, which of course is also bearish. If we take out these weekly fibs now from the top all the way down to the bottom, notice that this is tying in nicely as well with a 38.2 rejection, again confirming that this is healthy bear flag consolidation in this overall range. Granted, it's a large range, but it is bear flag consolidation nonetheless, so on the weekly time frame, everything falls into the bear category. Let's quickly take a peek at our volume profile, which we've been doing recently. We're going to zoom in just a little bit here. There we go, that's a little bit better. Remember that markets like to move from high volume node to high volume node. They kind of act as magnets, and then when you get there, you sort of either find support or resistance. So this high volume node certainly offered some resistance on the test. Obviously, we've rolled over there, and now we're coming back into this high volume node. Now, is it going to offer support the second time around is, of course, the question to always answer. Usually the first touch is the most important and meaningful touch for a bounce. If you test it in short proximity of time off of a lower high, again, H pattern, bear flag, whatever you want to call it, generally speaking, you're not looking at this to provide a super significant amount of support the second go around. So if we, remember what we just said, high volume node to high volume node, what's the next significant one here on the weekly time frame? Way down here is certainly the next one that catches my eye. Now, I'm not saying that the market in this upcoming week's worth of trade wants to move into like roughly 335, but in the grand scheme of things, if this pans out as a bear flag, the expected move could certainly take us closer to that area in the chart right here. Again, not in the course of 1 week, but over the course of 4, 5, maybe even a month or two, certainly could get into that area. And again, just something to be thinking about from the longer perspectives. If we want to think about what could be in store for this upcoming week, this weekly double bottom right here and smidge of a high volume node could be coming into play around 371, which we'll see on the daily time frame right now, because that's where we're headed to drill on down and talk about tradable levels into this upcoming week. So that was the weekly perspective. Bear with me as I quickly flip on our 50 and 200 SMA. That is in blue and green respectively, both simple moving averages. And our levels are popped on. Good. Everything's looking great. All right, let's address the expected move first. Remember that last week we mentioned, okay, we had this range compression. We're expecting some sort of expansion, and it would be okay to breach the upper or lower end of the expected move. Now that we've seen range expansion, I would not want to see this upcoming week the top end or the bottom end breached of the expected move. Last week, you can see I left the box on here, we got roughly a 2 sigma move. Notice we've closed here almost a full standard deviation outside of sort of this here, right? 1 and 2 to the downside. So a 2 sigma move. That, generally speaking, we don't want to see that happen again now that we've already experienced range expansion. So from the expected move perspective, the top end is roughly aligned with the gap fill overhead. Of course, on Friday, we opened on a gap down and we had no buying pressure to fill the gap and correct some of the overly net short inventory. That to me strikes me as a big red flag and a sign that we could be headed lower just based on the fact that, again, buyers didn't want to step up and do what they quote unquote should have done on the Friday morning session. Now, the other dynamic that's in play here, if we do move lower on the Monday morning session, is that we have 100% retracement back in play. Right? We've talked about this in the past as we were making this move right here, that we were expecting some sort of dead cat bounce before we got immediate follow through. That same thing is going to hold true this time around, right? So here's your 100% retracement. We have not formed any sort of lower high. The move does not look like this into that 100% retracement. So because of that, I would say, fishing for new money shorts at 385 might not be the wisest idea into the earlier stages of the week. We'll take a look at something in the internals as well, which would support that theory. So, coming into here, fine, but going through it early on in the week, probably not something that we want to be eyeballing as a likely scenario, noting everything that we've just discussed. Now, we did take a look at the 371. Again, that is going to be your support down below. But something else I want to point out, we took a look again at the weekly fibs. Let's take a look at the daily fibs from the bullish perspective, right? So here was your 38.2 consolidation bull flag. Everything was sort of, playing nicely. Obviously, Thursday, breakdown of the 38.2, but more importantly on Friday, the close and price acceptance underneath the 61.8 Fibonacci, which again greatly increases the odds that you do see the 100% retracement come to fruition. So of course, that also falling into the bearish category. So overall, we talked about filling the gap. I would probably look for rejection at the top in that gap fill area around 401.39 and the top of the weekly expected move. It's slightly higher around 403. Even if we were to come in for a back test of the breakdown up here on the bottom end of this, remember that all of the people who are fishing for longs in this area expecting a breakout will be overhead supply looking to sell at break even. Therefore, we should expect selling pressure at that 407, aka resistance, for some sort of rollover. So even if we are met with some sort of upward lift early on this week, I think the more tactful trade is to wait for the short against any of those levels that we've just pointed out to the upside. Again, probably don't push your luck early on if we just get continuation lower into 385. You're not looking for new money shorts until we either consolidate sideways or put in a little bit of a dead cat bounce and then roll over for the equal low reattempt breakdown. Okay, that's what we've got from a levels perspective. Let's take a look sort of behind the scenes, if you will, at our sectors and see what's going on from this perspective. So the XLP consumer staple is up first on the chopping block, filling the gap on the Friday session. A little bit of relative strength from that perspective, but do just remember that the XLP is actually a defensive category. So, it doesn't really strike me as like, okay, this is going to save the day for the marketplace because we filled the gap in the XLP. As a matter of fact, it filled the gap and then found some resistance, right? You can see a little bit of an upper wick there on the Friday session. So nonetheless, certainly falling into the bear category, not able to break out from sort of this consolidation up here and get continuation higher. Bearish. Utilities, what's going on in this one? Again, filling the gap, but much more neutral, falling back down into this range. Remember that this is a defensive asset class as well. So to see it going sideways here is actually okay to me. It's not the end of the world here inside of utilities. Not really concerned with the structure in this chart. Next up, the XLK, perhaps one of our most important sectors, or the most important sector, the tech sector, obviously breaking down from its balance range right here. Big gap in play, coming in for the equal lows. Again, the downtrend has just sort of reaffirmed that, yes, it's in play. The double bottom neckline did not hold. Obviously, we're underneath that as well, in the S&P 500 itself. So everything here pointing towards lower. Would you chase it for shorts early on this upcoming week? Again, I'm personally of the belief that maybe a day of consolidation then breakdown could be something that we could watch out for, especially noting, and I guess we'll talk about this when we get to the financials, and even after that, Wednesday at 2 p.m., we are going to get the Fed funds rate. Jerome Powell with his economic projections and, of course, the press conference afterwards. So do expect a fair bit of volatility on the Wednesday session. The reason I bring this up, though, is because the market, again, as I've just outlined, might want to go sideways Monday and Tuesday, wait for the reaction and sort of news on Wednesday, and then pick a direction either up or down. Based on the hot inflation read that came out on Friday, I am imagining that they're not going to have great things to say about the plans for continuing to put into place rate hikes, right? Maybe they're going to go for the 0.75 or even 100 basis points in the next sort of go around of rate hikes. So something to be mindful of, obviously, as rate hikes sort of are on the table and increase, that will put downward pressure on your XLK, the tech sector overall. And again, being the heaviest weighted sector, it's going to put a lot of downward pressure on the S&P 500. Continuing along, moving a little bit quicker through the remainder of the sectors here, XLY kind of in no man's land, this thin structure on the way up. I would imagine the look is for lower here. It is sort of day one of the breakdown of balance. Notice that on the Thursday session, we did not take out the low, whereas we did in the XLK and the SPY. So this can see continuation to the downside. I wouldn't be overly concerned with that just yet here. XLF, really bearish. Obviously coming in for the equal low down here, completely underneath the neckline of the double bottom. Remember that during this phase right here, a lot of relative strength actually. There was a decent amount of distance between the neckline and the low end of consolidation. The fact that it gave it all up and again is once again here at the lows doesn't really strike me as a good thing for our markets. Now we did talk about the 100% retracement phenomenon. That holds true here in your XLF. So maybe a little bit of a dead cat bounce, but nonetheless, anything that sort of forms a lower high now is valid as continuing the downtrend, right? So high, lower high, lower high. Even if we rally and fill the gap and reverse off of it, just another lower high, equal low, sets up the move for lower after that. Obviously downward pressure for your S&P 500. So XLF early on in the week, maybe watch out for sideways and then lower if rates sort of have to go through the roof, right? Next up, we've got the XLC for communications. Again, keeping it brief here. Here's your double bottom underneath the neckline, falling out of the consolidation here. Equal low, 100% retracement. A little bit of sideways, then lower. Probably the favored outcome here, noting that the trend is clearly to the downside still. All of the slight improvements that we were seeing in the sectors, right? All of these double bottoms and then acceptance above with these sort of flags that were put into place, all of that has sort of been wiped off the table, right? No longer are our sectors looking like they're starting to improve and show signs of risk on. We'll see that on the ratio grid in just a second as well. Industrials, what's happening here? Obviously a really lightweight sector, so not overly concerned. Downward channel is still in play. Lower high is in play. Until, if this were to breach the lows here around 88 and start pushing to significant lower levels, 85, 80 even, yeah, then that's more of a red flag. But for now, just sort of like normally bearish, really nothing to read into because again, it is such a lightweight sector. And I would echo that same sentiment here in the material sector, the XLB, until it breaks 80 and starts pushing significant new lower lows, just, averagely bearish. It's downward pressure for the S&P 500, but such a lightweight sector, we're not going to spend the time and read into it too much. XLRE, real estate. Obviously, this has a lot to do with rates as the inflation read came out and the market sort of anticipates a really aggressive stance on inflation, aka increasing rates at a more aggressive rate. Higher rates, lower real estate prices, right? So that's the relationship between what's going on here. Obviously, a new lower low was produced, so anything that even bounces is still, fine. Very likely that we put in a lower high at this point in time, and because we have the lower low, we can afford to put in a lower high, right? There can be a rally, and it, it still doesn't change the fact that we're bearish, right? Because of this lower low that we have. Next up, we've got energy. Obviously, perhaps the most defensive sector of them all, really the one that's taking the spotlight as of right now. 3 mild days of pullback as the market gaps and sort of falls apart on Friday. Just a mild day inside of energy, hanging out up here at the highs. No big concern. Big sort of risk off signal for the marketplace, obviously, right? As oil remains expensive, it puts pressure on the consumer. As there's pressure on the consumer, obviously your markets don't do as well. So energy hanging out up here at the highs does not strike me as a good sign for the marketplace overall. Next but not least, we have the XLV. Again, the second heaviest weighted sector by market cap, needs to hold 125. Otherwise, we're falling out of a massive, I would say that this is obviously a monthly balance area at this point in time, which we don't want to see resolve lower. Obviously, that would be massive bearish drag for the S&P 500. There was, for all intents and purposes, not much gap fill overhead on the Friday session. A little bit of an upper wick there, but it certainly did not fill a majority of the gap. And obviously, it's underneath its support trend line. So this budding new uptrend here was no longer in play. Instead, on the weekly, you would notice that you have an H pattern here. Instead of our higher low double bottom neckline remaining in force and the support trend line remaining in force, higher lows, it's obviously not the case. So again, this budding uptrend has now been quote unquote destroyed, right? The bears are taking control once again. We are expecting more bearish outcomes in the short-term future. Let's take a quick peek at our ratio grid. We'll keep it simple here. The top four are deteriorating. Notice that the descending triangle is still in force on the XLK chart instead of breaking that resistance trend line to the upside and starting to again show some signs of a new budding uptrend. Not the case. So risk off in technology. XLV perking up a little bit, but as we know, it takes more than just one of four to start to turn the sentiment back to risk on. XLY still a considerable distance to that descending 50 SMA. That's the gold line. So not a good look there. Risk off still. And the XLF, perhaps one of the more promising looks at first, as it was taking out the gold line, getting some acceptance above this sort of range it had been in. Yeah, obviously we're right back down at these lows here. So not a great look inside of financials for any sort of indication of risk on. Our bottom four are the risk off sectors, and obviously they're continuing to perk up. XLP perking up. Energy, it doesn't really, we shouldn't rehash that, but just everything just, screaming to the upside here in the risk off sectors, and even real estate just going sideways and slightly perking up in its overall range, but, not deteriorating, certainly. So that is still defensive as well. The market is not at all ready for risk on mode. Let's take a quick peek at some other things. We mentioned that the TNX will be a brief glance here as we talk about FOMC, which is coming out again, just as a reminder, because it's worth reminding, Wednesday at 2 p.m. Expect a lot of volatility with the economic projections, the Fed funds rate, and the FOMC press conference from Jerome Powell at 2:30. These are all things you need to be aware of this upcoming week. Really, really important week. Could be historic for the market here. Nonetheless, in the TNX, continuing to push on upward here, we wanted to see it remain nice and sort of sideways around 2.9 to 3%. Obviously, it made a new closing high on the Friday session, putting a lot of downward pressure on our XLK, which in turn, the heaviest weighted sector in the S&Ps, caused the S&Ps to come on down, right? This is directly tied to the way that the Fed is trying to combat inflation as of right now. As they, continue to issue rate hikes, this should continue to have support and just continue to have more momentum to the upside, right? No drag, nothing really stopping it from moving higher here in the TNX. So of course, you want to see this pull back if you're looking for market bottoms. If you want a crash to happen in the marketplace, you want to see rates go to like 4% over the course of the next 3 days or so, right? Next up, we've got to look at the VIX. The VIX is our volatility index back inside of the box, right? So we were talking about in the past, this box right here, why was the market not really moving lower why was the VIX not moving lower as the market was going sideways? That was sort of a red flag to us, right? And the fact that this is back in the box would indicate, okay, we're still in store for a rocky ride here. There certainly is no sign of this being a concrete bottom as of right now. And perhaps more importantly than the VIX itself is the VVIX, which is the volatility of the volatility index. Notice that in the past, right, this is the floor for all intents and purposes when market conditions are quote unquote normal. We were underneath that, right? This was a big red flag. No one was hedging inside of volatility. The volatility index was compressed, right? So for all intents and purposes, because this is perking back up, the participants in the market are starting to identify essentially that, hey, maybe it is worth buying some calls in the VIX and we should hedge some of our bets, aka they're seeing some more downside risk on the horizon, which is confirming everything we've discussed so far in our S&P 500. Let's take a quick peek at our market internals. If you don't know, and by the way, if you want to set up this exact sector ratio grid that I have, check out this video in the top right-hand corner. I've got it set up for you. It's a little tutorial there. And as this is loading, I've got another tutorial describing what these market internals are in the top right-hand corner, how to set them up, how they help you make better intraday trading decisions. Anyways, in the volume, all I want to point out for this past week's worth of trade is the fact that internals were confirming the breakdown. There's no major divergence. There's no major red flag that would make us skeptical of the selling pressure that's been here. Usually, we're looking at negative 300 million or positive 300 million as a sort of big inflection point, or, to classify something as significant. Obviously, we've almost doubled that on the Friday and Thursday sessions here, reaching at negative 600 million. So the outflows in the marketplace are real and the selling pressure is real. One little concern here is the fact that we were overly correlated on the Friday session. Generally speaking, it's very hard for markets to sustain any sort of pressure underneath negative 2,000 in your advanced decline line. We did see that in the past couple of sessions. Let me just get some more days here. Let's see. It looks like we got to go a little bit further. I just think this is a really great example, so that's why I'm fishing for it. Here we go, right? So if you just look here, way over correlated to the downside on that Tuesday session. The very next day, there was a counter trend rally, just alleviate some of that over correlation. Does it have to happen that way? No, it doesn't have to happen that way. But again, this would just sort of support the theory that it's probably not wise to be chasing new money shorts on the 100% retracement into those levels we were just discussing on the S&P 500 levels themselves in the tick. Just again, confirming activity here on the Wednesday, Thursday, Friday session as we were getting balance before, really more muted reads. The bearish reads certainly again confirming the downward pressure that we saw as the breakdown was occurring. That's been the internals. The last thing I've got for you for the S&P 500 is our market profile. This is the Friday session right here. And again, if you're confused at what you're looking at, I've got a tutorial video for you in the top right-hand corner describing what this is and some of the terms we're about to use. The main concern is the fact that value has shifted lower. Don't get me wrong. You can see the point of control did migrate lower with price, and there's virtually no acceptance above. But notice that we had a string of single prints here. On top of that, add in a gap and single prints on your A period. Overall, again, is the market a little bit ahead of itself to the downside? Maybe. Obviously, we're coming out of 8 days of balance. So, we were expecting a little bit of a move here. But the fact that it just happened in this context, not great. Just like we talked about in the past, virgin points of control stacking up to the upside, right? We had this one here to kick us off, never tagged up here, never tagged up here, never tagged up here. That can happen on the downside as well, right? So we never tagged up here. And on Friday, obviously the point of control, really big distance between those two. But for all intents and purposes, I just want to point out the fact that, again, no time was spent in this area. And sellers might be a little bit ahead of themselves. Do we have anything else that would indicate that that would be the case? Yes, we just saw that on the market internals with our advanced decline line. The last thing I would point out here, and it's not immediately going to be in play because we're not opening above, is that we have lack of material excess at the lows of the Friday session. Really, there was no follow through as we got down into those levels. Perhaps it makes more sense to look at it on a 30-minute time frame in just a moment. But this level, if we come up and fill the gap, because the market did open up here at 6 o'clock, if we come up and fill the gap, treat that level as repaired. If for some reason the market rallies in the pre-market and we open inside the prior day's range, Friday's range, treat this level as weak. The prior low of day will be weak. If we get into it, lower high, whatever, there's some sort of bearish pattern around it, we would expect a breakdown underneath it. The last thing I'll leave you with, just because I know the S&P analysis here is sort of waning on, is that we did repair, now that this breakdown has happened, some of these virgin points of control, right? Some of these have been tagged up and we no longer have them stacking. This one, however, is the major one that we're concerned with. And also remember that in this profile, we have a poor low. So if that's attempted, again, I would imagine that the first reaction around this level, around 3807, 3806, is for a breakdown because, again, there's a poor low at this area. It is not repaired until we trade through it. So that's been a look through our market profile, sort of supporting the idea that we might be a little bit skeptical of just immediate downside, but if we can put in some acceptance of value lower, certainly we have some weak things to be looking at as breakdown points underneath us. Let's take a quick look at our QQQ and continue on through the broad market. Then we'll get into those core listed companies. What do we see here? Very similar to the psychology that we just discussed in the S&P 500. Virtually no acceptance in the gap on the Friday morning session. Buyers did not do their quote-unquote job. They're just not there. We're breaking down from 8 days of balance. We exceeded the expected move low end from last week. I would not want to see it underneath this upcoming week's expected move low, which is around 276.83. Also a prior gap on our chart. So if the market does move lower, we want to see a gap fill reversal if that's the case here. If we just kind of hang out here and see a move higher, again, we also don't want to see it breaching the top end of the weekly expected move. And I would imagine that we just, there's going to be significant resistance on the gap fill, top of the weekly expected move, and a retest of the breakdown point here at 302.50. If we were to take out the sort of daily Fibonacci's from here to here, obviously we're underneath the 61.8, and we are expecting follow through to the downside from that perspective as well. No need to rehash that. And on the weekly perspective, obviously from here to here, well underneath your 38.2, bear flag in play, just consolidation in the grand scheme of things if you're more of a swing trader with a longer time horizon. So QQQs, the outlook is of course bearish, breaking down from this balance area, and we have some targets that we've outlined in today's session so far. Next up, we've got the IWM Russell 2000 and the small caps. What's going on in small cap land? Interesting little bit of relative strength still, noting that we have not broken down underneath the support trend line. So really anchor touch 1, 2, and 3 on the Friday session, also tying in for a super support here at the 179 breakout point point from this section of the chart. Could this be a break, retest, and bounce? We will have to ultimately see early on in the upcoming week. Nonetheless, remember that this is just no longer pushing the highs up here, so I would not look at IWM as an indication that, hey, risk off is still, risk on is coming back into play. The fact that this has failed out of this sort of breakout right here, this failed, and obviously we're much lower. Again, more neutral to sort of back to risk off. Obviously, inside of small caps, not a really impressive move anymore, hanging out up here at the highs. Use the trend line as a major driver for the course of the upcoming week. If we bounce off of it, a little bit more neutral, obviously, for the marketplace. And if it just continues lower, look to fill up the triangle and get into the low end of the weekly expected move, which is tying in nicely with these lows as well. Just to give you a number, obviously that is going to be around 170, 180, 172 could be the figure that you use. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that being said, let's jump right on into Apple. So also breaking down underneath its balance area from right around in here. If you do remember last week's video, we were talking about the fact that this consolidation struck me as an early breakdown from this range here. And obviously that was sort of the correct line of thinking. Relative weakness in Apple is of course not a good thing for your broad market, noting that this is the heaviest weighted component of both the S&P 500 and the NASDAQ 100. So we are sitting at this weak level of support. The reason I classify it as weak is because all of these lows are equal. It's not one low. They're all equal, aka a stop run could be had underneath those levels. That is 137 on the breakdown here. Should get us into 132.60 on upside moves. Again, we are looking for rejections off of the gap fill area. If you're a scalper, don't get me wrong, you can trade long through the gap. It's significant enough in size to sort of take a long trade through there. But at the top end of the gap and even the back test of this breakdown point at 144.25, I would shift my stance to say, okay, obviously we've broken down from a failed bull flag. Could this be a break and retest on the downside that produces a move that looks like this? Certainly on the lookout for inverted hammers around that area. Again, 144.25, 142.47 is the gap fill, and the gap starts at 140.75. Obviously an increase in selling volume as this move has unfolded to the downside here inside of Apple. Let's continue along and take a quick peek at Netflix. What's going on in Netflix? Obviously the chart's just really ugly. Now that we've failed this budding uptrend, as I called it in our sort of sectors, again, breakdown point, gap, a little bit of a consolidation doji. It wasn't nearly as bearish as some of the other things that we've watched so far today, but breaking the uptrend is in and of itself, obviously a bearish implication. So I would look for the full filling up of the triangle, which is the move into 176.44. And even that, as we know, is a flush point with 1, 2, 3, 4, 5, 6-ish interactions all at the same level for the same reasons we just discussed in Apple. Probably a stop run underneath that for anyone who's still holding along through this mess in here, which would send the market lower, right? As those people close out, getting us closer to that 165 as a downside target. So for Netflix, consolidation, maybe a long scalp through the gap, but really not overstaying your welcome. You're flipping to the short bias on the sort of retest of the gap fill area, the breakdown point there, that's 192.22, or consolidation never fills the gap, breakdown is under 176.44 into the upcoming week. Next up, we've got Tesla. What's going on with Elon Musk and his sort of craziness? A little bit of relative strength here, I'm not going to lie, just based on the fact that we're not obviously at the lows, and sure, there's your original consolidation, but notice what happened on Friday. Again, really more indecisive around the low end of balance. Even though we explored underneath, aka that lower wick that was formed there, it's not like we saw acceleration to the downside and getting us into that 625. Now, that doesn't mean we can't go lower. I'm just pointing out that, again, weakness opportunities might be better in other names so far. If we do get acceleration under the 700, then you would, of course, be eyeballing the 625, remembering that this set of lows in here, quote unquote, needs to be cleaned up as it's a poor low, right? Back to back. Again, the same idea with the stop losses just sitting underneath. Obviously, the shorts that never really got paid in there as well might look to reinitiate something in there. So I would use that as a significant target at 625 on the downside. For longs, it's really got to be up and over 733. If I just show you on the 30-minute time frame, you'll notice why it's such a critical area. Obviously support. Let's actually get rid of our after hours. Here we go. It's looking a little bit cleaner. There we are. So support. Obviously big rally that day. Then resistance, and then sort of support. Breakdown comes from it, right? So the only time to flip back to being bullish is if we can recapture this level and then maybe move back up to the 780. But obviously, given the current market context, it's probably not going to be a likely scenario early on in the upcoming week. Next up, we've got AMD. What's happening here? Big failure at 100. Cause for concern, breaking down under the support trend line. Again, a budding uptrend uptrend has failed here. So bearish indication for the tech space in general. I would say this was the first one that was starting to show some signs of green shoots. And again, being back down under 100, breaking the support trend line does not strike me as, signs of improvement any longer. So we are looking for, what happens at 92.50. And the reason I say that is because, again, we're down aggressively 1, 2, 3 days. We had 3 days of balance up here. So, it's not like the market's coiled up here anymore inside of AMD. The range expansion has kind of happened. So I would watch for, maybe not even a short into 92.50, but consolidation here, then a breakdown could be a likely outcome. Or if we just obviously get like a really clear hammer candle, take out the hammer high, it's just for a retest of 100 for a dead cat bounce, right? That's what I would watch out for inside of AMD this upcoming week. Just, monitor for continuation lower, remembering that in the grand scheme of things on a weekly time frame, if you were to look at this, here's a weekly balance, look above and fail. Target is always the bottom end of the range. So maybe 85 could be in store over the course of time. Probably not early on in the week, but over the course of time. Next up, we've got Meta, which was old FB, right? META is the new ticker symbol here, really falling apart, really nasty compared to everything else that we've seen so far in today's session. So equal low is in force. I would imagine a dead cat bounce based on that 100% retracement theory. 176.20 is the number. If it doesn't happen, if we do just continue lower, you're probably going to favor shorts that are on retests of just continuation, right? Underneath that 176.20. So probably not chasing it short, but on the next dead cat bounce, lower high, that's where you're looking for entries to continue to the downside and get us closer to that 169 coming from right around in here. If there is upside, pretty difficult to pick out any structure obviously in there. I would be patient, and if we get a retest of the balance area lows from in here, 188.44, that's again where you're eyeballing for shorts. So any inverted hammers, just like we discussed in Apple, right? Anything that comes in there, intraday double top, head and shoulders, inverted hammer on the daily time frame, short under the lows, looking for a retracement back to here, giving us an H pattern overall. Next up, we've got NVIDIA. What's going on in this one? Breaking down from the balance. So Thursday just sneaking down a little bit underneath. Friday a little bit more follow through. We did certainly come into that target that we had on our radar, but nonetheless we've adjusted to 166.50, the bottom end of balance in here. So that's really the next look to see if we can find support in here. Again, just like we talked about in Apple, just like we talked about in Meta just a second ago, any bounces that come back into this area, this overhead supply should sell into that for a break even, and we're expecting rejections on any subsequent tests of 180. Now, interesting look here is that we did not make the equal low. We technically do have higher lows in place if we were support here. So maybe from that perspective, a little bit more neutral inside of NVIDIA, just something to be mindful of. Overall, I do again think that the downward pressure across the broad market is real, and especially if on Wednesday afternoon they support an increase in rate hikes from 50 basis to 75, or God forbid 100 basis points, then NVIDIA is probably not going to fare so well, right? And we will watch out for some downside there. Downside targets here, 160 is a weak level. So again, any consolidation that then gets us here, that's where you're looking for a short entry possibility, noting a stop run underneath those lows. Next up, we've got Softy falling apart. Remember that this had a significant gap down that it rallied from, and that was sort of a sign of strength, the fact that it could pick up the sort of slack like that, but all of that's sort of gone out the window. We never broke out up and over this 273.50. Bearish, obviously no acceptance in the gap. This is literally just a rectangle for the daily bar there on the Friday session. Bears in full control, looking for continued breakdowns underneath 252.50 to get us into the lower wick here, the base of the support trend line around 246.44. From there, I would look for a little bit of a either consolidation period or lower high on a dead cat bounce. If it wants to bounce, I wouldn't really play long inside of the Friday session, and instead only look for that gap fill trade as the long setup over 261 to fill up towards 264.55. And then, once again, just like everything else, flip my bias to short, looking for rejections from overhead supply there. Next, last but not least, the no longer mini beast, we've got Amazon, right? So the split did happen on Monday, a little bit of an inverted hammer there, which has led to lower. Obviously, we're underneath the neckline of the double bottom right in here, and we are looking and scouting for lower at this point in time. As long as it remains underneath 114, bearish inside of Amazon, right? Watching out for bear flag consolidation here. Even if it fills the gap and rolls back over, again, that's obviously a bearish indication. Then looking for drives into the double bottom here for the equal low at 102.60. If it's going to be bullish, it's got to find a higher low back inside of this consolidation range right here above 120.38. Given the current look of the chart, doesn't really strike me as a high probability setup as of right now. The other way to get bullish, of course, is if some structure forms down here where we get a hammer candle that prints, maybe up and over the hammer highs for some sort of reversal, but we're yet to see if that's even going to be in place. So that's been the core list. Let's get into these two ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all those buttons YouTube tells us to tell you about. And let's get right into these ideas with PayPal up first. Obviously, just like many things, we had a new budding uptrend, maybe more similar to AMD, right? And obviously we've broken down here. However, notice that we have this very mechanical level at 76.83. A lot of eyeballs on that level. I'm sure it's a very obvious one. Any breakdown of that, I would just expect a snappy move into the most recent low here. Let's flip tools. Apologies for the misclick. Into the low around 71.83, just from a structural perspective. Again, if you think about this as a balance, would it seem reasonable that we could travel that distance in a day? Absolutely, here inside of PayPal. So short idea underneath 76.83 after a period of either balance or a lower high that then reattempts this after a lower high, right? So from here into here. Next up, we've got CVX, reasonable pullback in a glaring uptrend. Obviously, this is in the oil space. Chevron here is sort of your breakout point of an ascending triangle, right? Something that looked like this. Break and retest on the weekly time frame. Indecision doji on the daily session on Friday. Obviously not as bearish. We covered that in the XLE for the energy sector. So if this wants to perk back up, as long as it holds up above 175, remain bullish inside of CVX. Consolidation can continue here, and then breakouts resume up and over roughly these candle highs 181. So bullish in energy and bearish in PayPal, fintech, and companies of that nature. So that's what I've got for you on today's video. If you enjoyed it or learned anything new, let me know in the comments section or by giving the video a thumbs up. I greatly appreciate you tuning in, and I wish you all a green trading week.